Hello everyone, this is Brian Rezny, President of Rezny Wealth Management and host of the Rezny Wealth Report. Of course, we're going to take your calls, your questions, your concerns. If you'd like to email me a question, you can also do that at brianresny@reznywealth.com. Of course, we'll answer your question live on the TV show. We always enjoy hearing from our TV and our radio listeners. For those of you who don't know, I do a live radio show throughout Florida every Sunday from 10 a.m. to noon Eastern. If you would like to find out more about my firm, our staff, and our TV or radio programs so you can better profit from the economy, the investment markets, and make better sound financial decisions, visit my website, ReznyWealth.com. Today I want to talk a little bit about, investing behaviors. I've been managing money, by the way, for 28 years. I've seen pretty much everything out there that smart investors do and bad investors do. And I'll tell you, generally speaking, I'm going to cover 5 traits that often hurt you, the investor, your investment performance, create more risk in your portfolio, and ultimately hurt your long-term retirement. What investing behaviors undermine your investment performance? Number one is what we call the disposition effect. And this has probably happened to you before. What this essentially means is this: your tendency as an investor to hold investments in your portfolio as they continuously drop to lower and lower lows. Most investors that buy investments on their own or utilize a broker or so-called advisor who actually doesn't manage your money will be sold investments. They buy a stock or a bond fund or a mutual fund, and ultimately, let's say, one of those investments drops in value 20%. Because the reasons that it dropped 20% might warrant a reason to sell, investors that are utilizing a broker or so-called advisor, again, who doesn't manage your money, often will continue to hold that investment until it continues to drop more and more. Investors tend to sell at the bottom and they tend to buy high. You as an investor have to understand, before you buy any investment, you should also know the reasons that have to change fundamentally with that investment to trigger a sell, and not before it's down 40 or 50%, but maybe when it's only down 5 or 10%. Remember, every investment you buy today at some point in your investing career may need to be sold, whether that's tomorrow or 10 years from now. Without a sell discipline, you're going to be subject to the disposition effect and ultimately have underperformance and take more risk and lose more money. The other big one is focusing on past performance of, let's say, mutual funds and ignoring fees. This happens to a lot of investors. Investors tend to buy what did the best recently, like as an example, buying the best return mutual fund from last year or buying the best bond fund from last year. Ultimately, the reasons that that bond fund or that mutual fund had the best performance may not be the reasons it may perform equally or worse in the upcoming year or years. Again, even though an investment did well in the past does not mean it's going to do well in the future. The best example I can give you is this: bond mutual funds in general have done pretty well the last 5 and 10 years because interest rates were going down, so bond values go up, gives you outperformance. As rates bottom and rates slowly move up, the outperformance that most of these bond investments have seen will actually start being evaporated and go down. So make sure you understand. Don't focus on past performance. Understand what made that performance and will it have a chance to continue or reverse course. Familiarity bias. This is a big one. I would estimate about 90 to 95% of investors who come into our offices to have us review their portfolios and ultimately hire us to manage their wealth have about 90 to 95% of their money in stock and bond related investments in the U.S. They miss all the other investment asset categories, not only here but around the world. Again, familiarity means you buy what you're familiar with, and I see this a lot with people who buy individual stocks. They'll buy the big name companies like GE or Microsoft. Even those might not be great investments, they buy them simply because they've heard of the company. So again, just because you're familiar with the name doesn't mean it's a good investment. And if your portfolio is stacked 90 to 95% just in the U.S., you're missing the boat on potential returns, and you're also taking more risk from other areas of the economy or the markets eventually. Naive diversification. This one hits a lot of investors. I remember having a client not too long ago hire my firm. He worked with one of the big Wall Street brokerage firms. He had all mutual funds in his portfolio. Half of those funds were in large cap stocks, and half of the mutual funds were basically in mid cap stock funds. He had 35 mutual funds. If I kind of cut those in half the funds were large, half the funds were in mid cap, but almost all the funds owned very similar stocks within each fund. So it's kind of like having a turkey sandwich with 8 slices of white bread, a little turkey, and 8 more slices of white bread. The client thought he was diversified, but he basically owned 36 mutual funds, which essentially had almost 100% overlap of the exact same stocks. No more diversification, just a lot more fees and expenses that went back to the brokerage house instead of your investment account for better performance. Noise trading. This one I've seen unfortunately occur so much in the last 5 and 10 years. Noise trading is simple, or noise investing. It's basic your emotional attitude to the news. People will basically hear a news story, whether it's negative or positive, and jump on that investment or sell that investment depending on how the outcome supposedly is. At the end of the day, noise or news is old, outdated, and you don't want to use it. When you're hearing about it on different news media, chances are it's already over. As an example, we had situations with Russia and Crimea. Again, if you reacted to that and you sold Russian stocks when that came out, you actually probably would have been a big loser because those markets were already down and they've already started to recoup. And again, at the end of the day, what you hear on the news is noise, and it usually should not be put into your portfolio investment decisions because it's a day late and a dollar short. I'm going to go to your calls and your questions. You can send me an email question to brianrezny at reznywealth.com. Visit my website, reznywealth.com. Find out more about our firm, our services, and how you can professionally have your money managed without the conflicts of Wall Street and the poor investment advice they deliver. Andrew in Fort Myers. I only have $150,000 to invest. I can't afford to lose it. I'm investing in high yield preferred stocks. Does this make sense in my situation? Andrew, no, it does not. If you're telling me you can't afford to lose money, but you're buying, whether it's preferred stocks or individual stocks, you have risk. If you can't afford to lose money, then stick your money in a CD. You're not going to make anything, and that would not be a good investment strategy, but you can't have your cake and eat it too. At the end of the day, if you're buying preferred stocks or individual common stocks, they're all going to have fluctuation. So regardless what you invest in, whether it's a treasury bond, whether it's corporate bonds, stocks or mutual funds, all investments have a degree of volatility. What you want to avoid, Andrew, is permanent capital loss where your money drops and you lose all your money permanently. As an example, if you bought 10 individual stocks just because you were familiar with the name, like I talked earlier, and let's say one of those stocks was Enron and another stock was Eastman Kodak, both of those stocks are now out of business. So again, don't blindly buy investments without an investment strategy, and more importantly, you already have to have a criteria when you're going to sell that investment. Your broker and your so-called advisor working at the local bank, the guy selling annuities, or the Wall Street firm doesn't have your back and they don't manage your portfolio. So it's up to you. Unless you hire a registered investment advisor in a money management capacity, again, Andrew, you are on your own and you're taking way too much risk. Mike in Hollywood, Florida. I currently own 700 shares of WFM, which is Whole Foods, by the way, which has been on a roller coaster ride as of late. Should I hold this stock as my loss at this time is roughly $3,500? Mike, that's a great question. First off, I'm going to go back and ask you a simple question. You bought the stock for whatever reason, whatever research hopefully you did. What was your sell criteria before you bought that stock? My guess is, again, you've got the disposition effect. You bought a stock, you really bought it probably because you didn't do a lot of homework on that stock, and you bought it before you knew what fundamentals had to change in order to sell the stock. If you're already down on your luck, and by the way, Whole Foods I think is a great company, I don't think it's a great investment anymore, and for one simple reason. There are many competitors now that are getting into the specialty organic food segment. Some of the big players out there, by the way, some as much as Walmart and also Amazon. This could have a very big detrimental effect to Whole Foods' bottom line. So again, why did you buy the stock? And my guess is you never had a criteria why you would sell the stock or what had to change fundamentally. I don't like Whole Foods as an investment currently. Again, my opinion may change over time. I think it's a great company, but I don't think it's a great investment, and I think it's highly overvalued. If I owned it at this current point in time, given technicals and some of the fundamentals, I would be a net seller of that stock right now. If you have more questions, like our last caller in, you can always call us in the studio, or you can send me an email question to Brian Rezny at ReznyWealth.com. You can also visit my website, ReznyWealth.com. By the way, if you visit our website, you can sign up with your email address to gain instant access to updates, articles, and market calls that we send out via email all through the week. So if you're concerned about the economy, if the advice you're getting is not advice at all, or it's poor advice, or you're sick of Wall Street conflicts and the high cost, go to my website, ReznyWealth.com. We offer professional money management, and with a little click of your mouse, you can add your email address and get instant updates sent to your email box what we see in the economy and the investment markets, so you can make better decisions around your portfolio. Schmidt in Bonita Springs, Florida. What is your opinion on municipal bond closed-end funds? They look like they took a small hit in the past week. The yields of these are reasonable. Schmidt, I think you're correct in the fact that the yields look reasonable. But I want to step back first. Closed-end mutual funds are different than open-end mutual funds. Closed-end mutual funds, like any investment, require a lot of research. Not all closed-end mutual funds are the same. In fact, a couple things that I would look at when I look at closed-end mutual fund, Schmidt. Number one, does it have leverage? Many closed-end mutual funds deploy leverage, anywhere from 20, 30, 40, 50%. Leverage takes on more risk. Also, a lot of closed-end mutual funds, whether it's muni or any other kind, often trade at either premiums or discounts to fair value. If it's traded at a fairly large premium, over 5 or 6%, usually you want to avoid that, because again, do you want to overpay for that asset if it's actually worth this, but you're paying this? The other thing to look at when you're looking at closed-end mutual funds, a lot of people look at the distribution rate, or what they perceive they're getting. A lot of these closed-end funds are paying distribution rates of, let's say, 8%. That's not your yield or dividend, that's your distribution rate. Distribution can come from the yield and also return of capital. So as an example, you could buy a closed-end fund, overpaid for it with leverage in today's investment market. You can get an 8% distribution. 6% of that distribution may be your own money, and 2% is actually yield from the investment. So at the end of the day, you're putting yourself in harm's way, substantial risk. Right now, I firmly believe, if I look at the two areas of the bond market, muni bonds, okay, and long-term high-yield bonds are probably the two most overvalued segments in the bond market. I would be very cautious on muni bonds at this point, and I would be extremely cautious on high-yield bonds. Lots of risk, little reward for what you're getting, and I think ultimately you're not going to be happy with the return. I think there's other areas in today's market that I would look at over muni bonds and high-yield bonds or bond funds. I'm going to take a short break. I'll be right back. Go to my website, ReznyWealth.com. You can sign up and download for free any of our reports. Why annuities are dangerous to your wealth and your retirement. How to avoid outliving your money during retirement, perfect for your retirees. And of course, our number one report, how to avoid your biggest risk as an investor. This is a groundbreaking report. It's a must read for anybody who doesn't want to take risk with their money. This report is guaranteed to open your eyes and finally realize the biggest risk you have as an investor is the one that you never saw coming. Go to ReznyWealth.com right now. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management, a fee-only registered investment advisory firm. We have a special report just for you pre-retirees and retirees, how to avoid outliving your money during retirement. We cover the major pitfalls many smart investors overlook and leave money on the table. Go to my website, ReznyWealth.com, and get your free report. And we're back. We're taking your calls, of course, and we're taking your questions. You can also send me a question to Brian Rezny at ReznyWealth.com. I'd encourage all of our TV listeners, make sure you go to my website, ReznyWealth.com. You can download any of our free reports. You can also sign up for instant access to our updates that we do. We send them out via email. You go there, you just plug in your email address, and every week we send you updates about what we see in the economy, the investment markets, what you should and should not be doing with your money. More importantly, we teach you how to avoid the annuity charlatans in the world, how to avoid Wall Street conflicts, and the local guy at the bank who unfortunately often do not work in your best interest. How to avoid bad investment advice is just one of the many reports that we have on our website. Go there now at ReznyWealth.com. Eleanor in Marco Island, Florida. I would like to put my husband's IRA and my IRA into the best dividend-paying stocks and use the dividends. What do you think? Eleanor, great question. First off, why do you want to pick a group of the best dividend-paying stocks? Are you able to actually research each one of those stocks ongoing? Because you don't want to buy and hold. That's failed. That has failed investors twice for over 50% decline since 2000. So if you can afford to take substantial risk, then go ahead, knock your socks off, buy a bunch of dividend-paying stocks. When the next recession hits, expect your portfolio to nosedive 30 to 50%. What I would rather have you do is develop an investment strategy. Don't buy individual stocks. Most individuals do not have the time, discipline, or the talent to do continuous daily research on individual stocks. I'd rather have you look at something called an ETF or an exchange traded fund. These are a basket of stocks. This way you don't have to research 5 or 10 stocks every day. You can buy one ETF that's well diversified. You won't have to worry about researching those investments every day. And you have better diversification and less volatility. The key that I'm going to suggest to you, though, Eleanor, is before you run off and start investing, you need to develop an investment strategy which includes when to sell. Most do-it-yourself investors do horrible jobs managing their own money. They don't have the time, they don't have the discipline in order to actually effectively manage their money. They buy investments based on familiarity that I talked about earlier, and they put those in the portfolio, and they do something called buy and hold because they magically think those investments will keep going up. Again, even good investments will drop when the next recession comes. How do you protect and when do you sell? That's why I firmly believe all investors, if you don't have really the time, discipline, or talent and the knowledge, then hire a real investment firm, not Wall Street, not the guy selling variable or equity index annuities, not the local bank rep, but a real fee-only registered investment advisory firm. That's who you should hire, that actually develops the investment strategy and actually implements the investment strategy, Eleanor, for you. Remember, the most important part of any investment strategy is risk management, or When do you sell those investments before they drop 50% and you lose a big chunk of your retirement? Pam in Miami, Florida. What do you think of Apple split? Is it a buy? Are splits good for stocks? First off, Pam, splits in general are not necessarily good or bad. So just because a company splits its shares, as an example, Apple had a split of its stock and it had a 10-to-1 split. So effectively, when that stock split, it means for every share you own, you now have, let's say, 10 shares. That is not good or bad. It doesn't necessarily help the performance or hurt it if you look at most studies. With Apple itself, you want to look at Apple as an investment. So regardless if it split or it didn't split, is Apple growing its business? Is it growing its earnings? And can it grow meaningfully based upon the current valuation? Remember, what drives stock prices higher is if the company can earn more money. If earnings can grow, the stock price has an opportunity, not a guarantee, but an opportunity to follow along with it. What happens with most stocks, Apple's a great example. Years ago, when Apple was an IPO or initial public offering many decades ago, Apple skyrocketed because their earnings and their growth potential was great and it was overvalued. Then Apple dropped a whole bunch and it kind of recharged back up over, let's say, the next decade. Every stock has a chance to go up and go down. Earnings and sales will drive stock prices up and down. If you buy stocks that are overvalued, as a general rule of thumb, if you're buying large cap stocks like Apple, and they are trading at valuations usually over 15 on a PE ratio, and if they're not growing earnings more than 5 to 8%, chances are that stock is probably fairly or overvalued. If you buy a stock, let's say like Apple as an example, and let's suppose it was trading at a 25 PE ratio, and the earnings were only growing 2%, that is grossly overvalued. If you bought a stock like Apple and is trading at a 10 PE ratio, and the earnings are growing 8 or 10%, that to me would be undervalued. So you want growth of earnings and low PE or low multiples in order to buy stocks that would have an opportunity, but not a guarantee, to hopefully go higher. Bill in Naples, Florida. With the market trading at new highs, should I be selling? You know, I get this question a lot, and I'll tell you what, Bill. Generally speaking, just because the market is at a new high doesn't mean you should sell. What's driving the equity markets higher and what statistically drives the equity markets higher are earnings. Earnings are gradually moving up. If earnings move up, there's an opportunity for those equity markets to go higher. So your comment about the markets are at an all-time high, is it a good time to sell? If you would have said that to me 3 years ago or 15 years ago, you would have been correct. The markets were at a new high. The key, though, is really earnings. So as long as earnings are expected to expand and grow, which, by the way, this year, we're looking at about an 8% growth of earnings on the S&P 500, valuations are pretty much on par on average, so they're not overvalued, undervalued. We have a chance for earnings to grow, meaning we have an opportunity for the S&P or stocks in certain categories to continue on their upward trend. Not to say that there's not going to be bumps in the road, but earnings drive equity prices. Until you get a topping of earnings and earnings start to slow and come down, that's one of the criteria that I would use as a firm in order to start selling equities. Now, we're currently not seeing that. Roger in Fort Myers, Florida. What if my company's 401k plan is lousy? What should I do? Roger, great question. If your company's 401k plan is lousy, if you're not working for them anymore, meaning it's a past employer, hire a real investment firm, a fee-only registered investment advisory firm like us. You can roll your money into a self-directed IRA and have it professionally managed. If your company's plan is lousy and you're still there, the best you can do is pick from what you have until some point in time you retire or you leave work, or some companies today are allowing you to do what's called an in-service transfer out even if you're still working there. Check with your company and see if they allow you to do that. Mary in Coral Gables, Florida. I own 2 variable annuities, all from Allianz. and 2 IRAs, individual. My advisor is recommending we transfer them into an equity index annuity with security benefit and Aviva. What do you think? Mary, fire your annuity salesman. Your annuity salesman is not an advisor at all. They're not fee only, and they're not working as a fiduciary, meaning in your best interest. Go to my website, download for free our 2 reports. Number 1, your biggest risk as an investor, and the other report, why annuities are dangerous to your wealth. All this person wants to do is reload you on a new commission for him or her and reload you with a huge back-end surrender. I would not own an annuity at all. Annuities are toxic, and I firmly believe that. Go to my website, ReznyWealth.com. If you're somebody's trying to sell you an annuity after the free steak dinner, I know your advisor's a nice guy, but if he's trying to sell you or she is trying to sell you an annuity, they're not an advisor at all. They're salespeople working under suitability. Their interests are far different than your retirement security. It's to line their pockets. Stay away from annuities. Get a second opinion. I'd love to have you call my firm. We can review the current annuities you have and see if we can help you get out of those without a lot of harm. Again, our website address is at the bottom of the screen. You can go there to sign up for a consultation. We would love to help you rebuild your portfolio. Joan in Fort Lauderdale, Florida. Can you explain fiduciary versus suitability? Joan, great question. Fiduciary, there's many advisors out there that use fancy titles. You never, ever want to use a fee-based firm. Fee-based is not fee only. You don't want to use a commission firm either. Fee-based firms and commission firms work under suitability and sometimes fiduciary, okay? Fiduciary means that firm has to legally work in your best interest all the time. None of the brokerage firms, none of the banks, none of the insurance companies are fee only. They often work mostly under suitability, sometimes come over fiduciary on some accounts. You want a fee-only firm that's fiduciary, working in your legal best interest. Under suitability, those firms don't work in your legal best interest, don't have to give you the best investment advice, don't have to show you the best investments or the cheapest investments, and they don't work for you. They work for their Wall Street firm, their bank, or their insurance company. If you want to learn more about fiduciary versus suitability, go to my website, ReznyWealth.com, download for free our #1 downloaded report. It's called Your #1 Risk as an Investor. Read it. It talks about more about suitability and fiduciary. Folks, I'm just about out of time. If you're tired of set it and forget it, Wall Street conflicts, poor investment advice, call my firm for a consultation. There is a difference. We invite you to experience it. We'll see you next week. Please visit my website, ReznyWealth.com, and call us for a consultation right now.